All right, let's talk about a really powerful tool that can help you spot hidden danger in a company before it becomes a huge problem. It's called the debt to equity ratio. And trust me, getting a handle on this is a total game changer for any investor out there. So, have you ever seen this happen? You're looking at a company, it seems totally solid, all the reports are glowing, and then bam, almost out of nowhere, the stock price just tanks. It leaves everyone scratching their heads, wondering what on earth went wrong. Well, a lot of the time, the answer is a problem that was hiding in plain sight right there on the balance sheet. And here it is. One of the biggest silent killers for a company's financial health is just having way too much debt. If a company takes on more loans than it can realistically handle, it can absolutely crush its profits, scare away investors, and in the end, it can completely wipe out your investment. But, and this is the important part, the good news is there's a pretty simple way to spot this red flag. And that brings us to our tool for today. The key metric we use to figure out just how much a company is relying on borrowed money is the debt to equity ratio, or the DE ratio for short. Honestly, you can think of it as a crucial piece of financial detective work. It's like we're putting on our detective hats right now. So the DE ratio is part of a bigger family of metrics, and they're called solvency ratios. The best way to think about them is like a long-term health checkup for a business. They're not just asking, hey, can the company pay its bills this month? No, they're asking the bigger question, is this company actually built to last for the long haul? Okay, so the D/E ratio in particular, it answers one really vital question. How is this company funding its operations? Is it using money from its owners? That's the equity, or is it running on money from lenders, which is the debt? This ratio gives us a crystal clear picture of how leveraged a company is, basically how much it's relying on borrowed cash. All right, so that's the what. Now for the how. Let's actually get our hands dirty and look at the mechanics of calculating this ratio. And I promise you, it is way simpler than it sounds. Plus, you can find these numbers on pretty much any company's balance sheet. And here it is, the formula. It's beautifully simple, really. On top, you've got the company's total liabilities. Just think of this as all its debts, everything from bank loans to the money it owes its suppliers. And then you just divide that by its shareholder equity, which we're going to break down in just a second. That's it. Simple, right? So what exactly is shareholder equity? Okay, the easiest way to wrap your head around it is to imagine this. If a company sold off absolutely everything it owns, that's all its assets, and then it used that big pile of cash to pay off every single one of its debts, that's all its liabilities, the money left over at the very end, that is the equity. It's the true net worth that really belongs to the shareholders. Okay, let's make this real with a quick example. Let's say we're analyzing a company, right? So, step 1, we look at their balance sheet and find their total assets are worth, let's say, 1.7 crore. Step 2, we see their total liabilities are 1 crore. Okay, so for step 3, we calculate the equity. We just subtract the liabilities from the assets, which gives us 70 lakh. Now for the final step, we just plug those numbers right into our formula. And we get our debt to equity ratio, 1.42. So what does that number actually tell us? Well, it means that for every 1 rupee of equity the owners have in the company has borrowed 1.42 rupees. So here's the million-dollar question, or, well, the 1.42 question. What does this actually mean for us as investors? Is that number good, or is it bad? Because, let's be honest, a number by itself is pretty meaningless, isn't it? We need context to understand the story it's trying to tell us. So let's move on to the most important part, interpretation. This is where we take that simple number and turn it into a genuinely smart investment decision. Okay, so the general overarching rule of thumb is pretty straightforward. A lower D/E ratio is almost always considered better and definitely safer. It just means the company is relying more on its own funds to grow instead of piling on risky debt. Let's actually visualize this to make it super clear. So our example company is sitting at 1.42. Now, look over here at a company with a ratio of exactly 1.00. That means it has a perfect balance, 1 rupee of debt for every 1 rupee of equity. But check this out. A company at 0.50, now that's even better because it has twice as much equity as it has debt. You can really see how the risk profile gets better and better as that ratio gets smaller. But, and this is a really big but, here's where we add a super critical layer of nuance. You can't just look at one company's number in a vacuum. It just doesn't work that way.
As this quote from our source material points out, you have to look at its neighborhood. You have to look at its peers. So, back to our company's 1.42 ratio. Is it a red flag? Well, the classic and correct answer is it depends. See, for an industry that needs a ton of cash to operate, like a big utility company or an airline, a ratio of 1.42 might be perfectly healthy, totally normal. But for, say, a tech startup or a consulting firm, that exact same number could be a massive warning sign. So the key takeaway here is that context is everything. You absolutely must compare the ratio to its industry peers. A number by itself is just noise, but a number in context? Now that is information. Okay, so let's wrap this up and put a bow on it by summarizing the absolute key things you need to remember. So, here are the 4 big takeaways. First, the DE ratio is like your financial x-ray for spotting hidden debt risk. Second, the formula is super simple. What the company owes divided by what the owners actually own. Third, all things being equal, a lower number is a safer number. And finally, the golden rule, the most important one. Context is king. You always have to compare the ratio to its competitors to get the real story. So, the next time you're researching a company, please don't just look at the flashy headlines of the stock chart. You now have the tool to pop open the hood and check its financial foundation for real. The only question left is, how are you going to use it to analyze risk and make an even smarter investment?